Hey, welcome back and welcome to Ask Annex. That's where we open up the mailbag, see what you're asking, and we try to get to it. In the studio, Fred Coleman, Branch Director and CFP at Annex Wealth Management. Hey, Fred.
Hey, Danny.
Matt Morzy, Director of Research, also CFP at Annex Wealth Management. Welcome to you.
Hey, Danny.
Question 1. Is there such thing as a Roth Conversion Ladder? If so, how does it work? So you normally hear about ladders with bond ladders, right?
Yeah. You usually hear bond ladders, and all that involves, usually timing of cash flows. And Roth Conversion Ladders are similar to that. Let's take a step back. With Roth conversions, that's taking the pre-tax dollars and saying, I'm voluntarily going to pay taxes and move that into a Roth bucket. When it comes to Roth Conversion Ladders, those are going to be typically used by those who are retiring early. So those that are pre-59 and a half. Because after 59 and a half, you can take money out of a Roth IRA tax and penalty free, including the earnings. What a Roth Conversion Ladder does is it allows you to, it's a strategy that allows you to access the funds a little bit earlier, or at least you're timing that. So how it works is, let's say you put money in a traditional 401k or IRA, and at some point you're going to convert that money, and you have to wait 5 years to access that money penalty free. So let's say you're 50 years old, you want to convert $50,000. Well, at 55, you've waited the 5 years, you can take that $50,000 tax free. Now that's just the basis of it. You could take the basis tax free, not the earnings or the growth. But the idea is you do that again the next year. Now you're 51, you convert 50,000. At 56, you got 50,000 to take out tax free. So you keep doing that, and that's building a ladder, like you said, Danny, similar to the bonds. So it's used as a cash flow planning tool, and it gives you access before 59 and a half. But in my opinion, it does take away the largest benefit of a Roth IRA, which is that tax-free growth. The biggest benefit to a Roth, whatever you put in there, you pay taxes on it right away, and then it grows as much as you want without having to pay any taxes to it. So it's all part of planning and, looking at your situation. It could work for some people, but again, it goes back to your financial plan.
Next up on Ask Annex, how can I mitigate risks in technology and automotive sectors that still might face trade disruptions? Recent gains in the NASDAQ 100 give me optimism, but I can't escape lingering doubt. I'm not sure when he wrote that, but how's the NASDAQ 100 doing?
It's a little down.
Everything's been chopped up, right?
It is a little bit down this year. International is really the only, as of when we're going through this, that has basically held up. And really, to me, and we've talked about this a lot, but I probably can't talk about enough, is diversification. And I think that's really the heart of the question is, how do you mitigate the risks in technology or the NASDAQ 100? A lot of people use the ETF QQQ because that represents that index. But diversification is how you mitigate risks in investing. And so it has done really well. You think about how great the S&P 500 has been for quite a while. But if you look over the last 10 years, the NASDAQ 100 has averaged over 17% gain per year over those 10 years versus the S&P, which is about 12.5. So as great as the S&P has done, the NASDAQ 100 has done even better. But so you start to think about, okay, if I want to mitigate some risk right now because of tariffs or because of pullbacks in the market or that extra volatility, you really want to start looking at different investments that have less technology exposure to balance that out. So maybe some forgotten parts of the market over the last few years would be small cap, international stocks, or maybe even large cap value stocks as well too. Each one of them is going to have less technology as a component of it. So when you're looking at the NASDAQ 100, roughly about 50% of that would be classified as a technology stock within that sector. But when you look at things like small cap by the Russell 2000, only 15% is technology, so much less. Even less than that in developed international stocks. If you look at like developed, so the EFA is about 10% technology. Emerging market has a little bit more. It's at 23 because you think of all the Chinese or Hong Kong technology companies. But Russell 1000 is about 10% technology. So a lot of those areas that have less technology exposure also going to be very different technology as well too within those areas. That provides you that diversification, mitigates some of the risks of the downside volatility, but still giving you areas of the market that probably can, weather the storm quite a bit more.
How many stocks are in the NASDAQ? Do you know? Do you want to look it up?
I would like to look that up.
Why don't you look it up real quick?
Keep asking me these questions like that.
Sorry, I thought I'd maybe ask a research guy in the investment department. I can tell you this: S&P 500 doesn't have 500 stocks.
It does not. You learned that from me.
Wait, no, okay, go ahead.
The NASDAQ right now has about 3,700 companies. So the NASDAQ 100 essentially is the largest non-financials in there. So they take out one sector of that from the NASDAQ perspective, but it is a very small part of that index.
Got about a minute for this one. My 45-year-old friend believes we should all rebalance our 401ks because of the rough performance of the S&P 500. I say he's way too young to worry about that.
Yeah, I mean, you certainly can, but this is a long-term thought process, and I think that's the gear of that question in terms of about being 45 and being a few years away from retirement or more than a few years away. You really want to think long-term and what is your risk tolerance and then to stick with it. And you think, too, every time you put money in, so every 2 weeks or so, it's buying more of those things, just helping you rebalance that along the way. But certainly seeing what your allocation is and making sure if it makes sense is the way to go. But I wouldn't make any changes or do anything just because the market's down a few percent.
Yeah, when you think about rebalancing, we're thinking about going back to your original allocation. So sometimes when the market does move, there are certain parts of your portfolio that can move a little bit too much, and then that may be a good time to rebalance. But that doesn't mean essentially change the allocation. You still want to stick to that long-term plan and rebalance back to that original allocation.
45 seem young or old to you?
It's getting up there.
You?
I'm pretty close, so hopefully it seems young.
Seems quite young to me. That is Ask Annex. Fred Coleman, Wealth Manager, Branch Director, CFP at Annex Wealth Management. Thanks.
Thanks, Danny.
Matt Morzy, Director of Research, CFP. Thank you.
Thank you.